What if everything you've been taught about economic prosperity is backwards? What if the moment when everyone feels richest, when confidence is highest, when the future seems brightest, is actually the most dangerous moment of all? What if I told you that every major financial collapse in history was preceded not by warning signs that people ignored, but by celebrations that drowned out those warnings? September 1929. Wall Street is euphoric. Stock prices have quintupled in 7 years. Millionaires are being created daily. The economist Irving Fisher declares that stocks have reached a permanently high plateau. Your barber confidently discusses his stock portfolio. Newspapers proclaim the dawn of endless prosperity. Then, within weeks, it all collapses. The party becomes a funeral. The Great Depression begins. This wasn't a freak accident. It's a pattern that repeats throughout history with terrifying consistency. And it's happening again right now. Welcome to Economic Mirage. I'm your host, and today we're exposing why prosperity always peaks just before financial collapse. By the end of this video, you'll see economic news through completely different eyes. But first, hit that subscribe button and turn on notifications, because this channel delivers the financial education they deliberately keep out of mainstream conversation. And smash the like button right now. It genuinely helps us reach more people who desperately need this knowledge. Here's the fundamental truth that changes everything. Extreme confidence isn't a sign of economic strength. It's a symptom of economic delusion. When everyone believes prosperity is guaranteed, when skepticism disappears, when people think wealth creation has become automatic, that's precisely when catastrophe is closest. Why? Because that confidence is built on foundations of debt, leverage, and mass psychology, rather than genuine economic fundamentals. Let me take you back to one of history's most dramatic examples. The year is 1636, and we're in the Netherlands during its golden age. The Dutch Republic is the wealthiest nation on earth. Amsterdam is Europe's financial powerhouse. Trade is booming, art and science are flourishing. Then something extraordinary happens with tulips. These exotic flowers, recently imported from Turkey, become objects of obsession. Initially, wealthy collectors want rare varieties for their gardens. Prices begin rising. But then speculation takes over. People start buying tulip bulbs not to plant them, but to sell them at higher prices. The psychology shifts from appreciation to speculation. By late 1636, a single bulb of a rare variety sells for more than 10 times a skilled craftsman's annual salary. We're talking about the price of a luxury canal house in Amsterdam for one flower bulb that will bloom once and then be ordinary. Carpenters mortgage their workshops. Bakers mortgage their bakeries. Entire families bet everything on tulips. Futures markets emerge in taverns. People trade contracts for tulips that haven't even been planted yet. Everyone has a story about someone who became wealthy overnight. The logic seems unbreakable. Tulips are scarce, demand keeps growing, prices have risen for months. Everyone who bought earlier made fortunes. Why would this end? Anyone questioning the valuations is ridiculed. You don't understand the market dynamics. You're jealous of others' success. You're a pessimist trying to ruin everyone's opportunity. The social pressure to participate becomes overwhelming. Nobody wants to be the fool left behind while everyone else gets rich. Then in February 1637, at a routine auction in Haarlem, something changes. Buyers don't show up as expected. Prices come in lower. The psychology flips instantly. If prices might not rise forever, why pay absurd amounts for flower bulbs? The greater fool has vanished. Panic erupts. Within weeks, tulip prices collapse over 90%. People who mortgaged everything are financially destroyed overnight. Families lose their homes. Businesses fail. The Dutch economy enters severe contraction. The peak of tulip mania was followed immediately by economic devastation. Now here's what you must understand. This isn't just quirky historical trivia. It's a template that is repeated constantly throughout human history. The specific assets change. Tulips, stocks, real estate, cryptocurrencies. But the underlying pattern remains identical. Fast forward to the 1920s in America. The country is experiencing unprecedented boom times. New technologies are revolutionizing life. Automobiles, radios, electricity, modern appliances. The stock market delivers spectacular returns year after year. Between 1922 and 1929, stock prices increase over 400%. Ordinary Americans become obsessed with stocks. Brokerage offices open nationwide. People who never invested before are buying stocks on margin, borrowing up to 90% of the purchase price. The reasoning seems logical. Why wouldn't you borrow at 6% to invest in stocks returning 20 or 30% annually? Financial advisors encourage maximum borrowing. Newspapers celebrate taxi drivers and secretaries becoming wealthy through stock investments. Prominent economists assure everyone that America has entered a fundamentally new era, where old limitations no longer apply. The boom will continue indefinitely. But beneath the celebration, danger is building. Stock valuations have become detached from company earnings. Price to earnings ratios reach 30, 40, sometimes 50, when historical norms are around 15. Anyone pointing this out is dismissed as hopelessly pessimistic, someone who doesn't understand that this time is different. Those 4 words, this time is different, appear before every financial collapse in history. Then October 1929 arrives. When the market doesn't decline, it implodes. Black Thursday and Black Tuesday see the Dow Jones fall 23% in 2 days. People who bought on margin receive margin calls they can't meet. Forced selling drives, prices lower, triggering more margin calls, forcing more selling. The death spiral accelerates. Over 3 years, the stock market loses 89% of its value. Banks fail by the thousands. Businesses close. Unemployment eventually hits 25%. The prosperity peak of 1929 is followed by the deepest depression in modern history. The pattern is unmistakable. Prosperity peaks just before collapse because the peak represents maximum leverage, maximum speculation, maximum participation, and maximum delusion. When there are no more buyers to push prices higher, when the last skeptic has been converted, when leverage has reached extremes, the reversal is inevitable. Now we're going to dissect the precise mechanisms that cause prosperity to peak right before financial collapse. These aren't abstract theories. They're concrete forces that have operated identically throughout history. Understanding them gives you a massive advantage over the crowd that gets swept up in euphoria. If you're getting real value from this education, hit that like button right now. It takes 1 second and dramatically increases how many people see this content. The algorithm rewards engagement, and every like helps spread financial literacy. Let's dive deep. The first mechanism is leverage, and it's the amplifier that turns booms into bubbles and corrections into catastrophes. Leverage means using borrowed money to magnify investment returns. During prosperity, leverage proliferates because it makes everyone feel brilliant. Here's how it works and why it's so deadly. Imagine buying a house for $200,000 with a $20,000 down payment, borrowing the rest. If the house appreciates to $240,000, you've made $40,000 on your $20,000 investment, a 200% return. The borrowed money amplified your gains tenfold. This is intoxicating. It creates the illusion that you're a financial genius. It encourages borrowing even more. But leverage works symmetrically in both directions. If that house drops to $160,000, you've lost your entire $20,000 investment, plus you're underwater, owing $40,000 more than the house is worth. The same leverage that made you feel brilliant now destroys you. And when millions of people are leveraged simultaneously and prices decline, it creates a cascade that feeds on itself. This exact dynamic devastated the global economy in 2008. In the early 2000s, housing prices began rising steadily. Rising prices attracted more buyers. More buyers pushed prices higher. Banks, seeing rising prices, concluded that lending was safe and loosened standards dramatically. They started offering mortgages with 0 down payment, no money required. They created ninja loans, no income, no job, no assets, where borrowers didn't even prove ability to repay. They offered adjustable rate mortgages with low teaser rates that would reset to unaffordable levels after a few years. They pushed interest-only mortgages where borrowers never paid down principal, betting price appreciation would build equity automatically. Why this recklessness? Because banks weren't keeping the loans. They'd originate mortgages, immediately sell them to investment banks, collect fees, and move on. Investment banks bundled thousands of mortgages into complex securities, got rating agencies to label them safe, then sold them to pension funds and investors worldwide. Everyone made fees. Nobody held the risk long term. The system was built entirely on one assumption. Housing prices would keep rising. As long as prices rose, borrowers who couldn't afford payments could refinance or sell at a profit. Banks made fees. Investment banks made fees. Rating agencies made fees. Real estate agents made fees. Everyone profited, so everyone promoted the boom. By 2006, housing prices in many markets reached 10 to 12 times median household income. Historically, the ratio had been 3 to 4 times. The math made no sense, but the narrative was powerful and universally repeated. Housing prices never decline nationally. This statement became accepted truth, built into financial models and regulatory assumptions. Then, in 2006, prices stopped rising. They didn't crash initially, they just stopped going up. But that was sufficient. Borrowers with adjustable rates saw payments reset to unaffordable levels. People planning to flip houses found no buyers. Defaults increased. Securities backed by these mortgages started losing value. Investment banks holding these securities reported losses. The leverage that amplified gains now amplified losses catastrophically. Investment banks were leveraged 30 to 1 or higher. A mere 3% decline in asset values wiped out their entire capital. Lehman Brothers collapsed in September 2008 in the largest bankruptcy in American history. The financial system froze, credit markets seized, the stock market crashed. The global economy entered its worst crisis since the 1930s. The second mechanism is what I call the narrative trap. Every boom creates a compelling story explaining why traditional rules no longer apply, why skepticism is outdated thinking, and why this time is different. These narratives are sophisticated, promoted by credentialed experts, and they're always catastrophically wrong. In the 1920s, the narrative was that mass production and technological progress had created permanent prosperity. In the 1990s, it was that the internet birthed a new economy, where profits were irrelevant because user growth was everything. Companies with zero revenue were valued at billions. In the 2000s, it was that financial engineering had eliminated risk from housing markets through securitization and diversification. Each narrative seemed plausible at the time. Each was backed by impressive data and analysis. Each convinced millions of intelligent people, and each proved disastrously wrong because they all made the same fundamental error. They assumed that recent trends would continue indefinitely and that human nature had somehow changed. The narrative trap is psychologically powerful because it provides intellectual justification for greed and speculation. It allows people to feel rational and informed while doing something fundamentally irrational. It transforms gambling into strategic investing. It converts speculation into recognizing paradigm shifts. And critically, it creates intense social pressure. Once the narrative dominates, questioning it makes you seem ignorant, outdated, or bitter. The third mechanism is herd behavior, one of the most powerful forces in financial markets. Humans are intensely social. We take cues from those around us. When we see everyone doing something, especially if they appear successful, we assume they possess knowledge we lack. We fear being left behind. We fear being the fool who missed the opportunity. This creates a self-reinforcing spiral. As more people join the boom, prices rise, which validates the decision to participate, which attracts more people. The boom feeds on itself, growing larger and more unstable. By the time it peaks, virtually everyone is participating. Your cab driver discusses stocks. Your hairdresser talks about investment portfolios. Family dinners become financial strategy sessions. This universal participation is actually a warning sign, not validation. When everyone is on one side of the boat tips. When everyone who can buy has bought, there are no more buyers to push prices higher. The peak has arrived. The fourth mechanism is the silencing of skeptics. During every boom, people raise warnings. They analyze data, identify unsustainable trends, highlight dangerous leverage. And during every boom, these people are attacked, marginalized, or ignored. Before 2008, analysts warning about the housing bubble were labeled perma-bears, who always predicted doom. They were told they didn't understand sophisticated modern risk management. Some lost jobs for excessive pessimism. Then, 2008 proved them correct, but millions had already lost homes and trillions in wealth had evaporated. The suppression of dissent is dangerous because it eliminates corrective mechanisms. In healthy markets, skeptics provide balance. They ask hard questions. They force advocates to justify positions. But during booms, this balance vanishes. Only optimistic voices are amplified. Only bullish projections are considered legitimate. An echo chamber forms where everyone reinforces everyone else's unfounded confidence. Welcome to the final section where everything becomes immediately relevant to your financial life right now. We've explored the history and dissected the mechanisms. Now we address the uncomfortable question, are these warning signs flashing today? And critically, what can you actually do to protect yourself? Before we continue, if this video has changed how you see economic news and market euphoria, share it. Send it to friends, family, anyone who needs this perspective. Financial education is the best defense against financial disaster, and you can help spread that defense by sharing this content. Let's be direct about what we're seeing in today's economy. Many of the warning signs we've discussed are visible right now. I'm not predicting an imminent crash. Nobody can predict exact timing, but I am going to show you what's happening and let you draw informed conclusions. First, asset valuations have reached levels that historically preceded major corrections. We've experienced one of the longest bull markets in history. The stock market has climbed to levels that, by traditional metrics, appear stretched. The Buffett indicator, which Warren Buffett calls probably the best single measure of valuation, compares total stock market capitalization to GDP. It has recently reached levels seen only twice before, right before the dot-com crash and right before the 2008 crisis. Real estate markets in many cities have seen prices surge to 10 or 12 times median household incomes, ratios that mirror pre-2008 levels. But elevated valuations alone don't guarantee crashes. Markets can remain overvalued for extended periods. What's more concerning is the combination of multiple warning signs appearing simultaneously. Second, we're witnessing universal participation reminiscent of previous boom peaks. Retail investing has exploded. Trading apps have made it effortless for anyone to trade stocks, options, and cryptocurrencies from their phones. During the pandemic, millions started trading for the first time, many using stimulus money and savings built up during lockdowns. Social media has amplified investment trends at unprecedented scale. Investment advice spreads virally through Reddit, Twitter, TikTok, and YouTube. Teenagers give each other stock tips. Meme stocks surge based on viral trends rather than company fundamentals. Your relatives who never invested before confidently discuss their portfolios. The cab driver is giving stock tips again, except now it's happening digitally at massive scale. Cryptocurrency markets exemplify this pattern. We've seen periods of extreme euphoria where everyone from tech billionaires to celebrities to people with zero financial background confidently predict massive price increases. The narrative is compelling. Cryptocurrency represents the future of money. Traditional finance is obsolete. Decentralization will revolutionize everything. Some of this may prove true long term, but the psychology surrounding it mirrors historical booms perfectly. Third, leverage has proliferated throughout the system at multiple levels. Margin debt, money borrowed to buy stocks, reached record levels in recent cycles. Corporate debt stands at historic highs, with much of it used not for productive investment but for stock buybacks that enrich executives with stock-based compensation. Government debt has exploded to levels that seemed impossible just years ago. Consumer debt remains substantial, with new mechanisms like buy now, pay later services making it easier than ever to spend money you don't have. This debt creates systemic fragility. Everything functions smoothly when asset prices rise and the economy grows, but any significant disruption can trigger cascading failures. The leverage that amplifies gains during good times amplifies losses catastrophically during downturns. Fourth, we're seeing the dismissal of skeptics characteristic of boom periods. People raising concerns about valuations, debt levels, or speculative excess are labeled doomers or permabears. Financial media tends to celebrate success stories while minimizing risks. Those warning about potential problems are dismissed as pessimists who don't understand that fundamental changes have occurred. There's that phrase again, fundamental changes. Now, this time is different. We're told that modern monetary policy has eliminated traditional business cycles, that technology companies deserve premium valuations because they're reshaping civilization, that certain assets will only appreciate forever. These narratives are variations of stories told before every crash throughout history. Fifth, financial speculation has become disconnected from productive economic activity. More people focus on getting rich through trading and speculation than through building businesses or developing valuable skills. Get-rich-quick mentality dominates social media. People discuss passive income strategies involving zero actual work or value creation. The focus has shifted from creating value to capturing value others create. So what should you actually do? Here's where clarity is essential. I'm not suggesting you panic and sell everything. That's not rational. Many people who tried timing markets, who sold waiting for crashes that didn't materialize on their timeline, missed years of gains and ended up worse off. The lesson from history isn't panic at warning signs. The lesson is manage risk, avoid excessive leverage, maintain perspective, and don't get swept into euphoria. Here are practical steps. First, understand your personal risk tolerance and time horizon. If you're young and won't need investment funds for decades, you can weather crashes that would devastate someone needing money soon. Your strategy should reflect your situation, not market trends or what others are doing. Second, eliminate or minimize personal leverage. People who get completely destroyed in crashes are almost always leveraged. If you own assets outright, crashes hurt but don't destroy you. You can hold through downturns and recover. But if you've borrowed to invest and markets crash, you can lose everything and still owe money. The temporary boost leverage provides during good times isn't worth the risk of total ruin. Third, maintain diversification across asset classes, sectors, and geographies. The hottest assets during booms often become the worst performers during busts. Diversification means you won't maximize gains during booms, but you also won't suffer catastrophic losses during crashes. Fourth, keep liquidity available. Having cash or easily accessible funds serves dual purposes: emergency resources if you lose income during crises, and capital to buy when others must sell. Wealth transfers during crashes. Having resources during crises is how sophisticated investors build generational wealth. Fifth, continue your financial education. Markets move in cycles. They always have and always will. Booms become busts. Busts become recoveries. Recoveries become booms. Understanding cycles doesn't mean predicting exact timing. It means avoiding extremes. You don't believe euphoria saying prosperity is permanent, and you don't succumb to despair saying recovery is impossible. Elite investors who build lasting wealth aren't those making the biggest bets during booms. They're those maintaining discipline, managing risk, and positioning to survive inevitable downturns. Warren Buffett didn't become wealthy chasing every hot trend. He became wealthy through consistent, disciplined investing over decades while avoiding catastrophic mistakes. Here's my final message. Prosperity peaks before collapse, not despite warning signs, but because of them. The warning signs are visible but dismissed during euphoria. Understanding this pattern is your protection. Not guaranteed protection. Nothing in finance is guaranteed, but the best protection available. Don't be a passive victim of economic cycles. Educate yourself, manage risk, maintain discipline. And critically, don't let euphoria override judgment. If this video provided valuable insights, subscribe to this channel right now. We release content weekly exploring these patterns and providing financial education, protecting your future. Hit the notification bell so you never miss new videos. Drop a comment sharing which warning signs concern you most. Let's build a community of financially educated people understanding these cycles. One absolutely critical final reminder: everything in this video is for educational purposes only. This is not financial advice. I don't know your personal situation, goals, risk tolerance, or timeline. Any financial decisions you make are your sole responsibility. Consult qualified financial professionals, understanding your specific circumstances before making major financial decisions. The history of financial booms and crashes teaches that crowds are usually wrong at extremes. When everyone is euphoric, danger lurks. When everyone despairs, opportunity emerges. Develop the intellectual independence to think differently, the emotional discipline to act differently, and the financial knowledge to recognize when it matters. Thank you for watching Economic Mirage. Stay informed, stay disciplined, and protect your financial future. I'll see you in the next video.